You're standing in the grocery store, cart loaded with milk, bread, maybe a small treat for the kids. You reach for your wallet, slide out that slim plastic card, and tap. Beep. Done. No cash changes hands. You walk out lighter. The bank covers the store instantly, and you'll settle up later. It feels effortless, magical, even, like the card is just a convenient bridge to your checking account. Buy now, bank pays now, you pay later. No big deal. That's the promise, a simple tool for ordinary people. But what if that innocent swipe wasn't just a shortcut? What if it was the entry point into a system that quietly turned everyday purchases into long-term lending relationships? We're about to peel back the layers of one of the most profitable financial systems ever built. And every layer leads back to you, the person holding the card. This isn't just a story about convenience. It's about how a helpful idea evolved into high-interest lending delivered through plastic. It's about tens of billions in profit, driven largely by interest that compounds quietly over time. And most importantly, it's about how the system remains legal through court decisions, regulatory trade-offs, and policy choices lawmakers made over decades. By the end, you'll see the core truth more clearly. The card in your wallet isn't neutral. When balances disappear quickly, profits shrink. When they last, profits grow. Once you see that structure, you can't quite unsee it. And maybe that's the first step toward taking back control. But who shaped those rules? And why? Welcome to Off the Record. Let's rewind to post-war America in the 1950s. Optimism everywhere. Spending rising. Carrying cash? Risky. Diners Club launches in 1950. At first, just restaurants. 20,000 people sign up that year. Merchants get paid quickly. Customers get convenience. It's a charge card, use it, receive the bill, pay it in full. No interest. Clean transaction. Payment tool, not a loan. Then, 1958. Bank of America introduces Bank AmeriCard, later known as Visa. Backed by a bank, it expands fast. And here's the shift that changes the economics. Revolving credit. You no longer have to pay the full balance, just a minimum. The rest carries forward, with interest. That adjustment seemed small. It wasn't. The card stops being just a bridge to your bank account. It becomes an open-ended line of credit. No fixed payoff date, no defined amortization schedule. The balance can persist month after month, as long as the minimum is met. American Express enters the market. Magnetic stripes arrive in the late 1960s. Networks link banks and merchants nationwide, then globally. Gas stations, department stores, eventually online shopping. Contactless taps. Each innovation makes transactions faster and more seamless. But beneath the convenience, the underlying model has changed. When customers pay in full, issuers earn primarily through merchant fees. When balances revolve, interest becomes the driver. That's the pivot. What began as a workaround for a forgotten wallet evolves into a lending product embedded in everyday life. The payment function remains visible. The credit function becomes central. And once the economics shift toward interest, the next question becomes unavoidable. How did this model become the national standard? Here's where it gets uncomfortable. The original promise, a direct bridge to your bank account, never disappeared. But once revolving credit became standard, credit cards stopped being just payment tools and became lending products. Pay in full every month. The issuer earns a small interchange fee from the merchant, usually 1 to 3%. Predictable, modest, carry a balance. The economics change completely. Now you're borrowing. The bank fronts the money for groceries, school supplies, or an unexpected repair. You repay over time with interest, and that interest is not incidental. It is central. Credit card companies make money in three main ways: interchange fees, various account fees, and interest on revolving balances. For the largest issuers, interest income accounts for roughly 80% of actual credit card profit, not swipe fees, not rewards programs. Interest. That is the structural shift. Today, the average rate on accounts carrying balances sits around 22%. At that level, even a few $1,000s can take years to meaningfully reduce if only minimum payments are made. And that minimum matters, because most issuers set it low, often just enough to cover interest and a small portion of principal. The balance remains. The interest continues. Look at a typical statement. Minimum payment due, $35. It appears manageable, but on a $6,000 balance at 22%, paying only the minimum can stretch repayment 20 to 30 years or more, depending on the formula used. Thousands of dollars in additional interest accumulate over time, and that's not a glitch. Once interest became the dominant revenue driver, the model didn't just grow, it scaled, which raises the real question. How did this structure become the national standard? In 2025 alone, US credit card purchase volume topped $6 trillion. Visa and MasterCard process most of it. Their combined revenue exceeded $70 billion, with profit margins far higher than most industries. For major banks, Chase, Citi, Bank of America, Capital One, credit cards are among their most profitable divisions. Billions in annual revenue, much of it driven by interest on revolving balances. Meanwhile, households carrying debt pay thousands a year in interest. Money that could build savings flows back into the system instead. Issuers segment carefully. Premium cards reward those who pay in full. Mass market cards generate profit from balances that persist. Everyone earns points. But the real engine runs on debt. As of 2026, Americans carried more than $1.28 trillion in credit card debt. The average balance among households carrying debt sits around $6,500, often far higher. Credit card debt rarely begins as luxury spending. More often, it starts as a bridge, a rent shortfall, a medical bill, groceries when income lags behind rising costs, a temporary gap. Revolving credit is designed to offer flexibility, but at average rates around 22%, balances can linger far longer than expected, especially when only minimum payments are made. What begins as short-term liquidity can become long-term repayment. For many households, thousands of dollars each year go toward interest alone. A $2,000 emergency at 22% doesn't stay $2,000 for long. Time, quietly, does the rest. Money that might otherwise build savings or reduce future risk. The system offers freedom, the ability to spend now and settle later. For some, that flexibility works exactly as intended. For others, the timeline stretches. Have you ever read the full terms? Most people haven't. They're long, dense, easy to skim past. Buried inside are penalty APR clauses that can raise your rate by 10 points, or more if you're even one day late on a payment. Rules about how payments are applied, often first to the lowest interest balance, allowing higher interest debt to keep growing. And details about how introductory rates expire and the real APR quietly takes over. All legal, all disclosed, structured in ways most people don't closely review. The industry spends millions on product design and presentation, emphasizing rewards while risk details receive far less attention. Behavioral research shows consumers tend to focus on benefits over risks. This is the layer most people never reach. The system isn't broken. It reflects deliberate policy choices. In 1978, the Supreme Court case Marquette National Bank versus First of Omaha Service Corporation changed everything. The court ruled that nationally chartered banks could export the interest rates allowed in their home state to customers nationwide. States quickly eliminated usury caps to attract credit card operations. A bank based in Delaware could now charge a customer in California 22%, even if California law would have capped it lower. State protections no longer constrained national banks. Congress never created a national cap. Fast forward to 2009. After years of criticism, the Card Act introduced several guardrails. Advance notice before rate increases, limits on retroactive hikes, clear payoff disclosures, and conditions on penalty APRs. But it did not cap interest rates. It did not require minimum payments high enough to meaningfully reduce principal. And it did not eliminate penalty APRs. Why? Because the industry argued strict caps would restrict credit access, particularly for higher-risk borrowers. Lawmakers accepted that trade-off. Later, Dodd-Frank limited the Consumer Financial Protection Bureau's authority to impose national usury caps without Congress. So today, rates still float freely, often above 22%. Minimum payments remain low. Penalty APRs remain legal. Proposals for a national rate cap still surface, 10%, 15%, sometimes bipartisan, and still face strong resistance. The debate has lasted nearly 50 years. This isn't regulatory failure. It's regulatory design. The structure persists because it was permitted to persist. This model has spread worldwide, across Europe, Asia, and Latin America. Local banks partner with Visa and MasterCard. Same revolving credit pitch, same traps. But many countries impose stricter rate caps or usury limits. The US stands out for its hands-off approach. One global system profiting off local struggles everywhere. Companies celebrate resilient cardholders in earnings calls. Translation? People who keep spending and carrying balances despite everything. What began as a convenient way to pay without cash has become one of the most profitable lending systems in modern finance. Most people think they're covering groceries or a utility bill. In reality, many are entering a balance that can follow them for years. And yet we keep using it because modern life often requires it. Renting a car, booking a hotel, building a credit history. The profits don't come from the swipe. They come from interest. That structure was enabled in 1978, when banks were allowed to export interest rates nationwide, and reinforced in 2009, when reforms added disclosures but left rates and minimum payments largely intact. The rules permit high APRs, low minimum payments, and penalty increases. Those aren't accidents. They are legal design choices. Now, step back to a normal week. You're tired. The fridge is empty. You tap the card. It's not luxury spending. It's routine. Then something breaks. A bill arrives. Income dips. The card becomes a bridge. The balance stays. Interest accumulates. Proposals for caps or stricter limits surface. Banks warn of reduced access. Lawmakers debate. The structure remains. Credit cards didn't drift into this model. Through court rulings and policy decisions, they became a system that works best when balances persist. The next swipe will look the same. But once you understand the incentives behind it, you know who benefits most over time. The system works exactly as it was structured. The question is whether most people understand the design they're living inside.